So we're going to have Aaron tackle the Walt Disney Company. Entertainment giant just had quarterly numbers out. Myself and Aaron have brought our families there so many times. We've probably put keeping them in business at this point. But, great park to visit, do the numbers match? And is it a good investment now is what we're going to look at.
So obviously, this is a company that does not need an introduction. The Walt Disney Company, symbol DIS, on the New York Exchange, trading at $109, almost a 200 billion market cap company. And I believe they just recently reinstated their dividends, so a little tiny yield there of just under 0.9%. So when we think of Disney, of course, we think of Mickey Mouse, we think of the parks, maybe even the cruises, but it's a very diversified media company. So it's divided into different segments, media networks and sports. So this includes different streaming services, including Disney Plus, ESPN Plus, and Hulu. There's the studio entertainment, which is the content production, direct-to-consumer streaming services, and then experiences and products. So these are the theme parks, resorts, cruises, and other types of products, like if you buy that overpriced original Mickey Mouse souvenir, like I did, and overpaid for it. So if we look at the 12-month stock chart here, it's really hard to judge a company by their stock chart in 2025. Obviously, a lot of volatility and recovery, as we've seen by many companies. Looking at the 5-year chart, Disney has really not done that much for investors over the past 5 years. Really would not wanted to have bought early in 2021. And it's really just kind of traded in a range for most of the last couple of years. But the company did just recently come out with its Q2 2025 results. They were, by all metrics that I was able to analyze, good, strong results. Revenues up 7% to $23.6 billion. Income before taxes was $3.1 billion versus $0.7. Adjusted EPS 145, up 20%. So good numbers in the Q2. Now, the income adjusted before taxes, that's obviously a big growth. There are some one times, but the adjusted EPS really gives a more normalized view of what happened in the quarter. So that 20% growth rate in per share earnings is strong. Like, that's what we would consider a strong growth rate if they were able to maintain it. Looking at the 6 months numbers, revenue up 6%, cash from operations up 84%, and then free cash flow up 100%. Now, obviously, that kind of growth is not sustainable. The cash flow from operations and free cash flow will fluctuate from year to year. But nice to see that good, strong free cash flow. And then looking into the current year, guidance, midpoint of adjusted EPS of 575. So that would be 16% year over year growth. So it looks like a good outlook as well. What are the company's key areas of growth? Well, there's their streaming service, obviously Disney Plus. Actually, my subscription actually lapsed to Disney Plus, but I am planning on renewing it. So this has been considered a big growth driver of the company. The direct-to-consumer operating income, again, strong. Launch of ESPN standalone DTC service. And then looking at the parks, experiences operating income up 13%. Consumer products up 14%. New cruise ship and multiple park expansion projects are happening. And then if you look at the studio and licensing, they're looking at strong upcoming theoretical slate and content licensing growth, which is probably why they're expecting another year of double-digit growth here. Now, what about the threats and the weaknesses? Well, people think Disney Plus streaming, there's a lot of opportunity there, and there is, but it's a highly, highly competitive space. Rising programming costs pressure the margins. You've got other players, a lot of players coming to market, and now people are starting to feel a little bit stretched on their streaming expenditures. I know I felt like that. When Netflix came out, it was like, wow, I could replace my cable with one or two streaming services and save a bunch of money. But now, to get a really good slate of programs, you need to have 6 or 7 streaming services, it seems. So a lot of competition. Subscriber trends, Q1 Disney Plus subscribers did slip a little bit. That is not a great sign. There's the macroeconomic and operational risks. There's a lot of macroeconomic uncertainty and headwinds, and this is ultimately a consumer business. Now, I do believe that there are aspects of the company that is somewhat defensive given the strong branding and diversification. But, if we're in a recession, people are going to spend less money on Disney cruises and parks and whatnot. Now, um, there is this talk about a massive decline in tourism into the US. One would wonder, well, how does this affect their park business there? That decline is real. I mean, those are, as far as I know, absolutely real numbers, and they are severe, or significant, rather. Now, but how does that affect Disney? I'm not sure it would affect them too much, because that goes back to the diversification of the company. They have parks all over the world, right? I mean, they have parks in Paris and Japan, other places. So even if they lose business in some of their parks, they could gain some business in others. So, um, but still, it does have the macroeconomic risk, leverage and rates. I'm not, debt levels have come up a little bit. They're not too excessive, about 2.4 times debt to EBITDA for a company like Disney is not too bad. But they do have some debt, so there is some interest rate risk there. Balance sheet, we just talked about it. Net debt, 40 billion, debt to EBITDA, 2.4 times. I'm not, that's not an excessive number. That's within the range, but I would also consider it fully leveraged. I mean, I'd probably rather see 2 to 2.5. It's in that range, but I don't want to see 2.5 to 3. I wouldn't get nervous, but once you get over 3, you are. So it is definitely a fully leveraged company, in my opinion, if you want a well-structured balance sheet. Valuation, just going off the midpoint of guidance, 19 times earnings, 16% growth rate. All things equal, I consider that to be a very reasonable valuation. But what is our take? Obviously, a leading global brand and a very well-diversified company. I think strong fundamentals overall. I do think that is a reasonable valuation based on the numbers that they are expecting now and what they just reported in the quarter. But I'm gonna give a caveat there, and that's that, like, Disney has not been a consistent growth story where you're getting that double digit 20 or 16% growth year over year. So we can't just model that in and expect it's going to happen. There's some fluctuation in the company's earnings. We would monitor subscriber trends at Disney Plus. That's pretty important if things continue to decline or that accelerates. And then, of course, there's the macroeconomic exposure and risk. So we're just going to continue to monitor. It's not a buy for us. I think long term, you could buy it. Very investable company, good fundamentals, but we're just monitoring.
Yeah, I think that's the thing. Like, and realistically, like you covered it, the fundamentals are trending, in the right direction. Like, I think when you covered it last in September of 2023, net debt to EBITDA was, trailing was like 3.5 times, I believe. It's down, to about 2.5 times, like you said. I'm pretty sure, like, adjusted EPS was declining. Now they're projecting back to growth. But again, you covered that where the company isn't consistently putting up these significant adjusted EPS growth figures every single year.
Yeah, let me tell you, I'll just say that if I was expecting 16% growth every year, 19 times multiple for a company like that would be, we wouldn't be having this conversation. I'd just be putting in my order, right?
Yeah.
But it all comes down to how confident are you that they can maintain a double-digit growth rate.
Mm-hmm.
So.
Yeah, and they've had some fluctuation on that, spottiness on maintaining a growth rate in that area long term.
Big time.